We went through support and resistance zones and how they're an excellent technical indicator on the charts to determine where price might reverse. However, a lot of traders get this confused with supply and demand zones, which we'll be going through in this video. So to begin with, we must understand that supply and demand zones are more of a sentimental indicator rather than a technical indicator. The best way to understand this is when the supply of a currency is higher than the demand for it, price falls. In other words, if supply is increased, either by central banks printing more money or investors selling a currency, and there's no demand for institutions or other investors to buy the excess currency, then price will be forced down rapidly. There's usually a period of consolidation beforehand where price slows and institutions prepare for the sell-offs. Let's move to the charts to show you what this looks like. So as you can see around here, there's a period of consolidation followed by a sharp sell-off. If we mark this area up, we can see when price comes back to the supply zone, there's another big sell-off because this is where there is no demand for the currency. This shows in this example, when price reaches this area, not many people will be willing to buy the Australian dollar. Instead, they'll be buying the Canadian dollar and selling the Australian dollar. However, supply zones can also occur in the middle of trends and is an excellent way to determine where to enter trades, as institutions will have sell limits in place. For example, we see a small period of consolidation followed by a strong move downwards. We mark this up and scroll to the right. We see another big sell-off. Again, this shows that buyers are not willing to enter at this price. Likewise, when demand is greater than the supply of a currency, then buyers will flock to get what they can at a good price, and so there'll be an explosive move to the upside. This works in the same way as supply zones, a period of consolidation followed by a bullish move. Let's look at these examples here. We see a period of consolidation followed by a strong bullish move to the upside. So we mark this area up as our demand zone, and as we see, when price comes back down to it, there's another bullish move. This can happen in multiple areas as price comes back down for a third time, and we can see when price enters a demand zone, sellers are not willing to enter, and so there'll be a massive bullish move. Again, moves can happen within moves, so if we scroll to the right, there's another period of consolidation here with a strong bullish move to the upside. If we mark this area out and we scroll to the right, we can see another bullish move upwards as soon as price hits the demand zone. How supply and demand zones differ to support and resistance is that support and resistance is where price historically likes to reverse, whereas at supply and demand zones, this is all to do with the price that buyers or sellers are willing to get in at. Combined with either fib ratios, patterns or candlesticks that we've been through in previous videos, this gives a strong probability that price will reverse and continue to move with the trend. Hopefully now you have an idea that there is a key difference between supply and demand zones and support and resistance areas. Thanks for watching my video, and don't forget to like and subscribe if you stay till the end.